A monk who trades, an MCX IPF initiative. Monk who trades, an MCX IPF initiative. You look really frail. What happened?
I recently got my blood test reports and it shows positive for hepatitis.
Monk always says be positive.
I recently got a tattoo done from an unauthorized parlor. The needles must have been infected.
The danger sign makes sense now.
We'll teach those parlor guys a lesson.
Your safety is your responsibility. It's your duty to check for the required certifications and ensure that you are not dealing with quacks. Ensure that you deal with and through only SEBI-registered intermediaries. You may check their details on the Commodity Exchange website www.mcxindia.com and SEBI website www.sebi.gov.in.
Okay, can we take off? Vikram, are you ready? Debo, ready? Okay, all right, I think we'll allow me a minute. I'll just do some screen share. Anita, please unmute only the speakers, the three panelists. Okay, all right. Welcome friends, welcome to this event, IMC MCX webinar on commodity cycles and investor response. I want to welcome two of my co-panelists, Vikram Dhawan and of course Debojit Dey. I'm not going to introduce them, it's going to be presumptuous on my part to introduce them. Because they know the subject very well and they've been in various conferences, and I'm sure those in the commodity space know them very well. But I'm not getting into that formality. What I want to mention is that SEBI has recognized over 20 institutions across India as accredited training institution for commodity derivatives. The IMC Chamber of Commerce is one of the 20 SEBI accredited training institution for commodity derivatives. And I'm proud to mention the IMC is the only chamber of commerce in India to get this distinction. And therefore IMC and MCX have joined hands over the last 4 years, 5 years. We have done numerous events in the commodity space, covering a whole lot of subjects, including various commodities of interest to MCX. And this is a part of that ongoing agreement and ongoing initiative and understanding between IMC and MCX to promote commodity markets. Today's topic obviously is, as you know, commodity cycles and investor response. Everyone these days is talking about, is there a commodity super cycle? Are we at the early stage of a commodity super cycle? People, those who have been in the space, commodity space, also know that the world faced a commodity super cycle, say from 1998 or 1995 till the global financial meltdown in 2008, 2009. Are we in that kind of a situation? And people are prompted to think about it primarily because markets have buoyed. Commodity markets have shown tremendous buoyancy over the last 12 months. Therefore, in this event, we are going to discuss commodity cycles and how should investors respond. Okay. And we have an ace investor to share with us his thoughts. And of course, we have an exchange, MCX, India's leading commodity derivatives exchange, also to share the exchange of thoughts on commodity cycles and how investors should respond. So let me start by making my presentation. I'll take about 10 or 12 minutes to complete my presentation, and then I'll first invite Vikram Dhawan to share his thoughts. So here we go. Now, are we in a boom, bust, boom cycle for commodities? We don't know. But what we know really is globally, this time last year, from June last year, commodity markets started to move up. Prices started to move up. We had an extraordinary commodity price collapse in the first quarter of 2020. That collapse continued into April and possibly even in May of 2020. Then came a small revival because of China. And therefore, in the third quarter, market actually started to look up. And in the fourth quarter, commodity markets started to move up quite rapidly. Whether it is energy products like crude oil, or whether it is metals, base metals or industrial metals, steel and iron ore, or copper, aluminium, nickel, zinc, etc., or even agriculture commodities for that matter, whether it is cotton or edible oils, including palm oil, soybean oil, corn, wheat, sugar, all these commodities, the prices started to rally. And I'll show another slide how prices have gained traction over the last 12 months. But the point simply is there has been a major rally across commodities, energy, in the energy complex, in the industrial metals complex, even in the precious metals complex. Gold, for example, we know in August last year breached $2,000 a troy ounce. And of course, agriculture. Palm oil prices have doubled from a year ago levels, as an example. And therefore, they've all gained massively over the last 12 months. And that is actually creating an impression in the minds of many people. And they're beginning to ask a question: are we in the beginning stage of one more commodity super cycle? Now, in 2020, we all know there was a massive demand destruction due to the pandemic, COVID-19, and related lockdown. In fact, the whole world was locked down in some sense. Certainly, India was locked down. The US also faced a tremendous amount of slowdown. Many of the European countries were locked down. I think virtually most parts of the world was actually locked down because of the pandemic. The business confidence turned very, very weak. And because there was a lockdown, there was not much of industrial activity. There was not much of production activity or processing activity or industrial consumption activity. And therefore, business confidence turned rather weak. And there was no fresh investment in productive capacity. This is what actually characterized the year 2020. And therefore, from this level of utter lack of confidence, shuttering of industrial activity, and very poor or low investment, and very low trade growth, global trade growth in commodities, I think we are now beginning to, we have actually come out of that low level trap. Now, what happens in 2021? Okay, now I think before that, I'll come to that. But let's look at this comparative table 2019, 2020, 2021. These are indicative prices for the month of June in the last 3 years. Crude oil, which is $65 a barrel. Brent, I'm talking about Brent primarily. We all know in April 2020, Brent collapsed to $16 or $17 a barrel, around that level, and the WTI went into negative territory. Okay? And from then, of course, after April, by June, I think it has started to recover. And what are the prices today? Today it is $76.6 Brent. Awesome, extraordinary increase in energy prices in general, but certainly Brent prices. Copper, same story, 5,900 very broadly June 2019 and in June 2020. And look where the prices are today. 9,400, driven primarily by China. Of course, growth, Chinese, to feed their ravenous appetite, massive appetite for consumption of base metals, particularly cotton. Look at cotton again, 66 cents a pound in 2019 June, which collapsed to 60 cents a pound by June 2020. Massive, fantastic recovery. In fact, it was last month close to 90 cents cents a pound in the US. And now, of course, there's a small correction. I think the price today is around 87 cents. 87 cents. Anyway, but then a substantial improvement from this time last year. Look at gold. Gold has had a stellar, very glittering performance over the last 3 years. 2019 June, $1,440 a troy ounce. And by June 2020, it was 1,775. Obviously, gold is known as a safe haven asset. Therefore, during times of uncertainty, during times of economic uncertainty, geopolitical instabilities, gold obviously, a lot of investment goes into gold. And what was in June, $1,775 an ounce in June, actually crossed $2,000 a troy ounce by August last year. Of course, there has been a correction after that. And the current prices are closer to 1775, 1780 an ounce as far as gold is concerned. This correction from the $2,000 level is primarily because the world is now beginning. There's a revival of confidence in the world market. We are kind of rapidly moving out of the COVID-induced economic slowdown. We are going out of that slowdown. Look at CPO, awesome bull run. $500 in 2019, $550 in 2020, and double that price. Actually, it was $1,100. There's a small correction in the last 3 or 4 weeks as far as crude palm oil is concerned. Otherwise, it was $1,100 in the month of May. Well, this is the kind of rally the commodity markets have faced across the world. And our market is not insulated from global influences. Indian commodity markets are rapidly integrating or already integrated substantially with the global market. And therefore, whatever happens in the global market does have an impact on the Indian commodity market. And we are able to see, we are able to, feel the pinch, as it were. Now, I want to talk again to this audience about my view of critical market drivers as far as commodities are concerned. One is economic growth. There's a strong positive correlation between economic growth and commodity consumption. When economic growth is robust, commodity consumption also expands rapidly. When economic growth slows down, commodity consumption also slows down. And we have seen it in the past, in the last 25, 30 years, that at least I have been tracking commodities. We know there's a strong positive correlation. Last year, when economic activity was at very low level, obviously commodity consumption took a big hit, and there was demand destruction, and therefore prices collapsed. Or we need to track in these times, all the time. In fact, for all those who have interest in commodities, either as a stakeholder in the value chain or as an investor, a financial investor in commodities, you must track economic growth, which is very, very important. The second one is geopolitics. Geopolitics, more often than not, refers to political uncertainty, a war-like situation. And if that war-like situation centers around the MENA region, Middle East, North Africa region, which is the hub of oil production, immediately geopolitical developments create a risk of disruption to oil supplies, crude oil supplies, and crude oil prices start to go up. Therefore, we need to track geopolitical developments. And when crude oil prices start to go up, there is always a tendency or a propensity for diversion of a part of the vegetable oil to produce either to produce biodiesel, for example, or to produce ethanol from corn, wheat, and sugarcane to mix with gasoline. For then, vegetable oil prices also move up. Your ethanol prices also move up when crude oil prices start to move up. So geopolitics has a big impact on commodity. Then we need to track monetary policy. Not many people actually appreciate the role of monetary policy. During normal times, the impact of monetary policy on commodity markets is rather limited, not limited, muted, rather muted. But now we are living in extraordinary times. After, since from last year, the second quarter of last year, we all know every country has given a stimulus package. Every country has adopted what I call ultra accommodative monetary policy. The Federal Reserve of the United States has dropped interest rates to near zero and has also printed more than $4 trillion and released in the economy. India has liberalized its monetary policy. And of course, there is a lot of fiscal relief also in terms of taxes and duties. Europe has done it, China has done it. But when you have very liberal monetary policy with low interest rates, there is huge liquidity of money. And therefore, when this liquidity, a part of the liquidity obviously moves into markets, into assets, various assets, including the stock market and the commodity market. And today's rally, this rally of the last 6 months, 8 months, is partly explained by a very liberal, ultra accommodative monetary policy of various central banks around the world. Therefore, we need to track this. The moment there are signals that the monetary policy is not going to be as liberal and is going to be tightened, you will see a certain impact on the market, which we are already beginning to see. I'm sure those of you who track these markets would know the signals that are coming from the US Fed. Then you have the role of currency. Currency is extremely important, particularly you need to track the dollar. The dollar has been rather weak over the last 15 or 18 months, particularly against the euro. And from a level of something like 1.13 or 1.14 to the euro, if I remember correctly, it depreciated to 1.21. And when the dollar depreciates, it lifts commodity prices. Those commodities which are designated in dollars, their prices actually. But now, in the last several days, the dollar has begun to strengthen. And I have always been bullish on the dollar. And the dollar has begun to strengthen, and that's showing in the commodity prices in the market. So currency is important. Same with dollar rupee. I think that exchange rate is also important for those of us, particularly in case of say commodities like gold, which we import on a large scale. Therefore, track the movement of currency. Then weather. This year, that is 2020-21, weather has been a major driver of agriculture commodities. While Southeast Asia and South Asia had the benefit of La Nina, we had rainfall 101% of the long period average last year. And La Nina brings surplus rainfall or excess rainfall to Europe, particularly to Asia, South Asia and Southeast Asia. An opposite effect takes place in South America. The same La Nina, which brings rainfall to South Asia, actually creates drought-like conditions in South America. And therefore, from the last quarter of last year and into the first quarter of this year, countries like Brazil and Argentina faced very, very dry conditions. Their soybean production dropped, their wheat production dropped, their corn production dropped, coffee production dropped. And we can see the sugarcane production in Brazil dropped. We can see the reason for this spike. So weather is something all of us obviously will have to track all the time. So these are the five primary drivers of the market: economic growth, geopolitics, monetary policy, currency, and weather. And the sixth driver obviously is funds. Okay, you can call it speculative funds or investable funds or institutional investment. Call what you want to, but funds definitely play an important role. Hedge funds, mutual funds, pension funds, all these also invest in commodities so that they are able to get a good return. Therefore, there are five primary drivers, and then you have a sixth driver, which is the funds. Now, I thought this was necessary for me to share with the participants who may be interested in investment in commodities. Okay. Now, currently, what is driving the market? The factors that are driving the market at the moment: one, sentiment, which was very weak, which was negative last year, is turning positive because of large-scale vaccination around the world. As a result, economic activity is sorry, started to actively to quickly recover and revive. As a result of which, demand for commodities is surging. And China, which actually amongst most of the countries, China got out of this very depressing economic activity much earlier than other countries, and I think possibly in the third quarter of 2020. And since then, China's appetite for consumption of commodities has been absolutely ravenous, huge, massive commodity. Therefore, China has always driven the commodity market. China is the mover and shaker of the market. But this time, after very weak sentiment, with the sentiment improving, China's appetite for consumption has been very, very high. And therefore, there is a combination at this point of time. We have massive liquidity by the central banks of various countries. Interest rates are very, very low. Very weak US dollar, although it is beginning to strengthen, they're still relatively weak. And then, of course, La Nina for agriculture market, particularly impacting South America and parts of Europe also. In fact, the Black Sea region was also impacted by that. And the markets are now, we faced a situation called a risk-off environment. People didn't want to take any risk. They didn't want to invest in any risky assets. And that is why the markets faced a big collapse last year. Most of the assets faced a big collapse last year. And that is now changing. And we are moving towards a risk-on environment, as a result of which a lot of speculative capital is actually moving into commodity markets, and of course, moving into equity markets also. Therefore, there is a combination. This kind of a combination does not occur very often. The last time, in fact, I wrote a piece in the Hindu Business Line about probably 2 weeks ago, 10, 12 days ago, that this actually reminds me of the situation of 2011, 12, 13. That's the time we had La Nina, and we had the US faced a worst drought of 50 years. The Midwest faced drought. The US dollar was weak. We had the quantitative easing by the Federal Reserve. Interest rates were very low. And the quantitative easing was because of the global financial meltdown of the 2008, 2009 period. All that combination has now actually happened again after 10 years. Whether this will happen 10 years from now, I don't know. But it's been exactly 10 years since it happened. So this is what is now driving the market at the moment. Therefore, my belief is that the market is in a state of cyclical recovery. And these commodity markets have always been subject to cycles. And then these cycles are driven by a host of factors. We saw those 5 or 6 factors, major drivers of the markets. And while in 2020, that is last year, we faced serious demand side problem. This year, we are facing supply side challenges. Okay. Last year, demand destruction is what we saw. And because there was demand destruction and collapse in prices, there was not much investment in creating productive capacities. And when demand starts to revive in a big way, there are obviously supply challenges. What my sense is that this is no a super cycle like the 90s, from the mid 90s, 1995 till 2008. China was the factor then. China used to grow double digit, 10, 11, 12, 13% GDP growth year on year. For several years, it grew. I can't see any major economy on the horizon, even now, attempting to grow at that level. Yes, India has the potential to grow at that level. But I think our direction is clear, but the scale is, of course, very, very different. I don't think we'll be able to match China. But anyway, so therefore, even today, I think the markets have not really recovered, commodity market, from the global financial crisis of 2008, 9, 10. This is my belief. So this is the recovery phase we will go through. This is a welcome recovery phase after a disastrous 2020, and therefore we must feel happy about this. Now, there are demand side shocks and supply side shocks which we need to understand. Now, when we look at commodities, supply is usually fixed. When we talk about short term, 3 months, 6 months, supplies are usually fixed, because you can't increase supply suddenly. It doesn't work that way. Whether it is crude oil production or metals, minerals, ore excavation, or even agriculture production for that matter. In the short term, supplies are usually fixed, and therefore for the short term, demand dynamics become extremely important. Therefore, if the demand is robust and the supply is fixed, prices will start to rise. Okay? And if you have enough supplies, the demand starts to shrink or does not grow, obviously prices will collapse, which is what we faced last year. But in the medium term, in a 6 months, 12 months, 18 month time frame, supplies and investment in productive capacities would become critical. This is a situation we are facing. Because, as I said earlier in one of the slides, there was not enough investment in productive capacities. We are facing now supply side shocks, supply side constraints, etc. And therefore supplies can't be increased overnight at will. That needs investment, and of course resource endowments of every country and the policies of every country would also matter. At the moment, everybody is talking about protectionism, and therefore that there was a disruption to the global value chain the whole of 2020, which is now reviving. But whether this attitude of protectionism will continue, we don't know. We can't say for sure. But every country certainly wants to protect its own interests. There is no doubt. Now, having said all this, how should the investors respond is what is important. My sense, and again, of course, we have experts like Vikram who will share his thoughts with us, and Debo from an exchange perspective. But I believe investors must recognize the nature of cycle to take a decision relating to investment in commodities. You should know the nature of cycle. Is it a demand-driven cycle, or is it a supply-driven cycle? Is it short-term, or is it medium to long-term? This is one. Second one, volatility in the short term and mega trends in the medium to long term, that create an investment opportunity. Therefore, you should be able to know how the market is behaving, and you should take advantage of the volatility in the short term. But certainly don't ignore the mega trends in the medium to long term, which create a medium to long term investment opportunity. And therefore, for example, the current energy transition that everybody is talking about is a mega trend that's beginning to happen, and it will happen over the next 10 years, 15 years, etc. And that's a great investment opportunity. But it is not an overnight phenomenon. It is a process, and therefore you need to invest today, wait for good results over a period of time. Urbanization is again another mega trend who nobody can stop. This is happening around the world, and it's happening even more rapidly in China than in most parts of the world. And it's certainly happening in India also, given the size of the population and other driving factors. And when you have urbanization, there is going to be demand growth for a wide range of commodities. And then, of course, there are similar mega trends that need to be tracked. Now, commodities will be either in surplus or in deficit. Therefore, we need to know the supply and demand fundamentals of commodity, and each commodity has its own demand and supply dynamics. Or when a commodity is in shortage, we know prices are going to rise. When a commodity is in surplus, we know prices will be soft. But the trickiest situation is when a commodity fundamentals, supply and demand are fairly balanced. When the market is fairly balanced, please be sure and be careful, because when the market is balanced, even a small change either in demand or supply can have a disproportionately larger impact on prices when the market is balanced. So surplus market, we know prices will be soft. Deficit market, we know prices will be high and firm. A balanced market is a very tricky market, which you got to be very focused on a balanced market. And therefore, you need to draw benefit from these insights into this market, for which investors must have adequate product knowledge and market knowledge. These are extremely important. You need to study the product. You need to study the dynamics of the market. You need to know the characteristics of the product that you're trying to invest in. Entry and exit strategies are extremely important. And as a teacher, I've always said that the exit strategy is even more important than the entry strategy. You can enter the market anytime, but you should know when to exit. Stop loss, when to stop your loss, how to stop your loss, when to book your profit and exit, etc. Those strategies are extremely important. And when you want to invest in the market, stay tuned all the time, because the markets are so volatile, so dynamic. Unlike the equity market, you invest in some top-rated companies and buy shares and keep it with you for 3 years, and you know for sure prices will rise because the economy is in an expansionary phase. But commodity markets are subject to volatility and ups and downs in prices, and therefore product knowledge, market knowledge, and staying tuned to the market is extremely important. I think I've taken, a little more time than I allotted to myself. Thank you very much. I just have to issue a disclaimer. I am not a trader. I'm not an investor. I don't hold any position either in the physical market or in the futures market. I'm a student of the market. I'm also a teacher of the market. So thank you very much. Good luck and God bless. I'll of course be with this till the end. And now I'm going to request Vikram to share his thoughts. And I'm going to now stop sharing screen. Stop sharing screen. Where is that? Yeah. Okay. All right. Vikram, it's all yours.
Thank you very much, sir. It's been a very detailed and articulate, description on what's happening in the commodity markets. So, yeah, I will try to make it as brief as possible. But it reminds me of a joke. The Woody Allen, a very famous filmmaker from US, who's very popular in the world as well. And he said he read the novel War and Peace, which goes into thousands of pages in 30 minutes. All he could figure out was it's about Russia. So I will not make it that brief also, that, I'm so the brevity takes away the whole purpose of this discussion. So yeah, I think I will continue from, where Sir has concluded his presentation. Investment is all about cycles, whether it is equity markets or whether it is debt market or commodities or gold. You have to understand the cycles. Don't worry about getting the timing right. because these cycles are mean reverting and they tend to come repeat themselves. Well, as they say, history doesn't repeat but rhymes. They continue to come and go. But I think most important is to understand what is driving the particular cycle. I will not go too much in the past because past cycles have been either driven by China or they have been driven by extraordinary increase or decrease in the global economic activities, whether it was a crisis or whether it was oil shock or etc. etc. So I'll just focus for the next 10-15 minutes. I'll focus on what's happening now, what's driving the commodity markets, what are the cycles which are in play. So the two most important trends, not only for commodities, for every sector, are environment and technology. If you want to invest into any sector today, you'll have to see how well, it's not just about commodities, how well they sit up with what's going to happen in the environmental and the tech sector in the future and what is already happening. You know, the what other trend is also in play, and this is only limited to commodities, is that commodities markets are emerging out of a very long winter, long slump. I mean, you have had intermittent bull runs, but if you see past 10-15 years, commodity have not given that much returns. Gold could be an exception, maybe some of the other metals. I mean, if you take away this recent rally, the performance of commodities was very dismal actually. So it is emerging out of a very long winter, and that is also one of the things which is affecting this cycle. So let's see how these three factors are affecting and driving the commodity cycle. Let's first talk about environment. One of the reasons that why we are even talking about environment is because of change of leadership in the US. If you remember the previous president, Donald Trump, he actually opted out of the Paris Climate Agreement. I will not go into the details of the Paris Climate Agreement. It's all available on the internet. But basically, it meant that the large countries were not, and if the world had to follow the president set by US, then basically meant that we are not bothered about how much we are polluting and what are our emissions. That has all changed. And under the new president of USA, Joe Biden, it looks like he wants to make environment as part of his legacy. And I have never seen this kind of urgency and this kind of expedition in the environmental field. In a short period of time, it's not even completed 1 year. There's so much which has happened on the environment. I remember putting a LinkedIn post last year saying that the hydrogen is going to be the next best, the biggest thing in commodities. I was actually expecting 10 years. But in less than 10 months, I think everybody is talking about hydrogen. Similarly, a couple of years back, I thought that maybe, well, it's not I means I was the only one, I was somebody exceptional. I means, obviously, we all read and figure out what's happening. It was figured that electric vehicles is going to be, the next big thing. And today, when I come down and walk around in the society, I see electric vehicles. It's becoming a lot more common. So, how environment is affecting is, first of all, after today, there's a dual effect, there's a double whammy. Since the commodity sector is emerging out of such a long winter, the managements, the boards, and the CEOs of the large mining companies are very averse to taking a risk on a new large greenfield project. Because the investors and the shareholders are very particular that if thanks to the higher commodity prices, the cash flows of these companies have improved. Stock prices can go higher. Why it is not going higher? Because there is a past legacy, and people suspect that once again when the prices go up, there will be increase in production in most of these commodities, and we'll see a repeat of 2011-12, when from gold to copper there was a surge in production, and what happened after that, it's all history, especially in gold. So one thing is very sure that despite of higher prices, the large mining companies which have the balance sheet and the financial muscle will not binge on new projects or production. Unless, of course, we see the prices remaining higher for a lot longer. And lot longer doesn't mean 1 or 2 quarters. It means at least a couple of years. If the prices remain higher next year as well, towards the end of next year as well, then you would see some sort of a significant material supply, response coming in the market. Obviously, in the interim, there will be smaller companies who, like startups and like mid-cap and small-cap stocks, would like to encash on this commodity boom. But by and large, I think no CEO of a mining company would risk putting money in a project in a rapidly evolving environmental environment in which the project can be stalled and he or the board will lose their jobs. So that is one thing. And secondly, the banks are also not very much eager to add to their already existing loans to the mining industry, especially if they don't tick the boxes in the environmental boxes. Who would have thought a few years back that India also we will have 500,000 ton of copper production being shuttered because of environmental reasons. So environment is actually knocking on the door, and we cannot close our eyes from it. I've been living in Mumbai for almost 25, 30 years. And very recently, in the past few years, I have seen, I'm sure you must have also seen, incidents of high intensity wind, whether you want to call them hurricanes or typhoon, doing landfill has gone up significantly. We cannot simply blame the Chinese and the Americans that, they are polluting and that's why the world is suffering. We are all in the same boat and we all swim and sink together. And that I think has at least percolated very well at the G7, G30 level. And emerging economies, while they may have the aspirations, but it is a question of how and where they will find the funds for it. So that is how environment is, and combination of environment and the shareholder activism you want to call, or shareholder, doubts and apprehension, which will keep a leash on how much additional capacity can come in, despite of higher prices. Now, again, if you talk particularly when you're talking about environment, if you talk particularly about, suppose let us say we talk about very specific sectors. Now, obviously, in the given time, I would like to touch on agri, how environment is affecting the agri, and why spikes in agri commodity prices are going to be a lot more frequent than what we have seen in the past decade or so. So there is a very, very significant trend of deforestation, agricultural land being used for industrial purposes, and scarcity of water. I think whatever said is less as far as the water scarcity is concerned. So you have a shrinking yield of the agri commodities, and on top of that, if you think that if you add the affluence which the emerging economies like India and China are fast. China has already achieved a level of affluence, but still it is growing pretty rapidly compared to its size. And India also will, attain. Obviously, COVID is just a hiccup. We are on way to growing very strongly and eventually becoming an affluent economy. It might take some time. It will happen. So the trend that we have seen globally in agri economy is that as the countries become more affluent and rich, the agri consumption goes up significantly, and that leads to not because people start eating more, but because there's a lot more wastages. Now, obviously, agri markets are violently mean reverting, and it comes with a caution. But I think the larger trend is in the industrial economy, especially energy and metals. If you talk about metals, again, the trend which is emerging and which has been there for quite a few years is the trend of electric vehicles. If you are convinced that your next car is going to be an electric vehicle, then I think you should be actually investing directly or indirectly in base metals. Why? Because in the next 20, 30 years, there will not be enough copper, nickel available for meeting these demands. I mean, already there are startups which are emerging, which intend to mine copper, nickel, and all the metals from the seabed. So that is a kind of actually, if the electric vehicles have to reach just 20 to 30% of the of the sales. Currently, I think they're not even 1% globally. If they have to reach 20-30% of the sales in the next 10 years, then the supply of all the base metals, most of them has to double. Suppose if something is being produced at 500,000 ton, let's say copper, the growth is about quarter to 500,000 ton annually supply growth, that has to double, go to 1 million ton. And for zinc, for nickel, it is actually 2 to 3 times. So we are talking in terms of X's, 1x, 2x, and 3x. You're not talking about some 30% growth or 40% growth. And it is staring at us. I'm not saying tomorrow morning we should go and buy copper and nickel with all your money, because these trends will take time to manifest. It will take years and decades. In the interim, you will also see bear markets, interim bear markets, where the market will fall down and people will lose faith. What happened a few days back when the base metals corrected by some 10-15%, whatever. And I think there's so many people, I got so many calls from people, well, is the rally over? You said that, this and that. I said, yes, maybe the rally is over now. But if you have an horizon of few years, then I think it's an excellent opportunity to relook at the sector. Again, I am I am from the mutual fund, and I have to put two big disclaimers that the past performance of any commodity or any security is no guarantee of future returns. And I am not here to give you any buying or trading calls. It is just my personal view, and frankly, I like to stick out my neck. Whether it gets guillotined or garlanded, I don't know, but somebody has to stick out their neck and make a view. So that is as far as the metal is concerned. Now, one thing you'll have to also appreciate, which doesn't get publicized much about electric vehicles, is that electric vehicles have got everything going right. And for instance, in terms of the construction of the car, the battery tends to be at a lower, it's got a lower center of gravity, more stable. At the high-end car, you can have, if it's a four-wheel car, you can have 4 motors and 4 wheels. So it is something which cannot be replicated in the internal combustion cars. And last but not the least, why the auto companies love electric cars is because the moving parts in an electric car are 1/5 to 1/10 of what you have in an internal combustion car. So it takes less people, less time, it is less complicated, and it's easier to design and easier to repair as well. So it has got everything going for it. And we may argue that the electricity that we are using is being produced by dirty coal or gas or whatever it is. But I think if in India, we know what is happening in Delhi and NCR in terms of pollution. And in Mumbai also, we get these, these bouts of very bad pollution. And, yes, it is not a free meal. If electric vehicles are running on our streets or cities are getting cleaner, there is some plant somewhere which will be belching out, pollution through coal. Now, either that has to be, if you go to Australia, it is such a big country that, you can actually have a very polluting, smelter or something anywhere in the middle, and there will not be anybody thousands of miles around to even bother about getting affected of it. So we are not in that situation. But yes, there are ways and means of mitigating that, pollution. But I think the cities have to be clean, because otherwise, what happens is that, it leads to a lot of medical issues, and it leads to a lot of loss of productivity and so many things. So yeah, so that is as far as the metals are concerned. I'm being very brief because there's so much to talk and I don't want to take too much of time. Talking about very quickly, I'll touch upon the energy markets. Now, obviously before the US shale gas came in, OPEC had absolute, control over the oil markets. They produce about they still account about 1/3 of the production. And if you combine Russia with it, it's close to about 40. That's a lot of, to creating a cartel in commodities, you just need 5% to 10% of the market. So they are still the elephant in the room.
Yeah.
But when the shale production came in from the US, and for those of you who don't know what shale is basically the oil which is embedded in the rocks. So it has to be, it has to be blown away with high pressure steam. It is deep in the, under the earth crust. So, so once the shale gas became viable in North America, including Canada also, there was a competition over the control over the market. And that competition became really very nasty and ugly few years back, including last year when, they were both OPEC and shale was trying to shut each other down, so much so that they managed to get the prices into negative territory. And every time, if you see the charts of oil prices, every time they have gone to below $40 or $30, you can see the production of shale and OPEC, they're at their historical peaks. So they try to shut each other. It's like two shops in a neighborhood trying to shut each other. Now they have learned that they have to coexist. And what has also happened is, to the detriment of the oil consumers, that what the shale industry actually grew up in a very typical startup sort of a scattered, sort of a capitalist American structure that it was more of a Silicon Valley of rather than a very corporate sort of structures which existed in the shale, fields, which means there was no production discipline, there was no finance discipline in most of these countries. And I think at the last count, they still own about anywhere between $200 to $400 billion to the banks, and most of it would be bad debts. So they're not getting any fresh capital in a hurry. That is one thing. And in their, in their quest to keep the prices down, so typically what happens in a mining is that you try to have a combination of deep wells and shallow wells to keep the cost, at a certain median level. But that discipline was not followed. And it seems that most of the low-hanging fruit in shale is almost over. So the shale price, the shale cost of production, which was touted to be about $15 or $10, I don't know what the current cost is, but I think it's definitely not that. And I would like to hazard a guess. It is more towards $40 to $60 than it is towards $10, $20. You have a you have a higher floor on the shale prices. Also, now that the shale companies are being acquired by corporates, they are instilling cash flow and income and balance sheet discipline. You will not see this kind of supply response from shale that we had seen in the past. So that is why even though the prices are approaching $80, shale production has remained flat. Now you may say there is an unofficial cartel going on here, but fact of the matter is that prices can go to still higher from here without even getting a substantial, response from shale. So whether it is energy, whether it is metals, or whether it is agri, there are some fundamental long-term trends which are factored, which are based upon environment and technology, which are driving these markets. And these trends are very hard to ignore. I mean, just talking about electric vehicles also, it's a very fast changing environment. Today we have lithium, which is the main driver of the batteries. Tomorrow, I mean, there is the way there was a, there was a stampede to, sort of find the vaccine for COVID. Similarly, you have a similar and a much larger scale. There's a massive effort and capital being deployed to find something other than lithium, which can, so that you can extract the same amount of power and, the life, whether it is nickel or copper or aluminum. We don't know what's going to happen. But yes, I think knowing the auto industry, they'll be extremely, extremely nervous if they are dependent upon just one or two metals and one or two countries for the supplies. They will not. So a lot will happen. We don't know. It could be aluminium. It could be next. It could be nickel, which becomes even more. I mean, already they are in. We have a looming shortage in all these metals. So this is a very rapidly changing, developing situation. Similarly, for environment also, we have to wait and see. I mean, India is betting big on solar energy. Solar energy means that more silver consumption, obviously the bet on solar energy is not an option. It's more of a necessity. And when you have these kind of things coming, then silver prices can double from here without actually altering the course of the solar industry. I'm not saying silver will double from here, but I'm saying that the prices can go much higher without affecting the outlay of the solar industry. So yeah, so these are some of the challenges, some of the trends which are in play, and these are very long cycles. There will be intermittent bear markets, and I think the best way to have a look at this market is to be patient, to wait for corrections, or to enter into this market in a systematic way and take a very long-term call. But I think most importantly, you should be convinced of its trend. Do you think environment and technology will drive the markets going ahead? If you think they are going to be the main drivers, then yes, commodities is a place where you can have a good proxy for it. If you think not, maybe it's a fad. Maybe Joe Biden, President Biden may not get elected the next term, and it is all finished. Again, it's a call which is very difficult to take at this point of time. But also, most of these trends are coming from overseas, so they are more like imposed upon us. And sitting over here, thousands of miles away, we can only make an estimate, an opinion, and a best case of it because we are not there. And I think perhaps people sitting over there also don't know which is going to be the next big thing in whether it is electric vehicles or environment, etc., etc. So yeah, so there's a lot to talk about. I will just briefly stop here. And I was also asked to speak upon hedge policy, which is again a topic very dear to me. I'll just finish. I'll say a couple of lines on that. All corporates. I've had the fortune of managing some of the largest hedging books in India, and mostly in metals. And I think as an entrepreneur, as this CEO or risk manager, you got to be very, very clear. What are you achieving out of your hedging policy? Are you trying to, using hedging for your P&L, balance sheet, or cash flow? Because all three of them have got absolutely different connotations. I mean, one of the reasons I got a job as a hedging manager was because this was the precondition by the large investors that if you have a metal company and the prices are very volatile, if you don't have a good risk management, then we are just at the hostage of the the commodity cycle. So what additional you can do to ensure that the volatility of returns are much lesser compared to the volatility in commodity prices. Similarly, if you are using hedging to make your balance sheet stronger, then it has to be a more long-term asset liability approach. Not worry too much on what level you hedge and what you hedge. It is just you have liability, you have assets, and your balance sheet is secured. If you're managing it for cash flow, then obviously it is more of a opportunistic hedging because you would like to increase. There will be an element of trading involved, whether you like it or not, because ultimately it will affect your cash flow. If it is to make your P&L stronger, then you should use hedging to reduce the volatility of your returns. So prices go up, go down. Obviously, prices go down. The hedging strategy should ensure that your realizations don't go down significantly. But then you'll have to also forego certain upsides. Basically, you try to reduce. In an ideal world, if you have a strong balance sheet and a P&L which is not volatile and a cash flow which is strong, well, you can get whatever valuation you want. So yeah, I mean, it's at this I will take a pause and pass on the floor to the next speaker, and probably I'll pass it on to Chandrasekhar sir, and he will then take it from there.
Thank you, Vikram, for sharing your very mature view. Yes, what is important is that we need to track trends. As I say, make trend your friend, and we need to know what are those long-term trends that are going to be occurring, and that have started and are going to gather pace, say in the coming years or etc. And one of them obviously is electric vehicles that you referred to. Yes, very important. And the beauty is electric vehicles are commodity intensive. Electric vehicles are metals intensive. And that is why they are going to have more and more demand for metals like copper. All right. So very interesting. But the electric vehicle revolution is not going to take away the demand for rubber, for example. Because these even electric vehicles will have rubber tires. Okay. Electric vehicle revolution is not going to take away demand for cotton, technical textiles, for example, seat cushion, for instance. And therefore, but they will certainly be, the cars will be, vehicles will be metals intensive, and there'll be more and more demand for metals like copper, etc. And then of course, for battery, lithium ion, etc. All that. I think these are trends that one must notice. And one can actually invest in either those commodities or also invest in those commodity producing companies. One can have various strategies, but our idea today is to look more and more at cycles and how the investor should respond. Thank you very much, Vikram. We'll, time permitting, I'll come back to you. I'll now go to Debjyoti. I call him Debo, of course. Therefore, Debo will share his perspective as an exchange representative. The exchange has a very important role to play in commodity derivatives. In fact, that's the platform. And SEBI, as all of us know, in the last 2 or 3 years, has taken a number of initiatives to deepen and widen the commodity derivatives market. SEBI has allowed introduction of options trading. It has allowed introduction of index trading. It is PMS is allowed, portfolio management service. Your mutual funds are allowed to trade commodities. AIF 3, category 3, alternate investment fund, category 3 is allowed to trade commodities. And many more new products are in the pipeline. And I'm sure there will be many more new participants also that would be coming in. The process has already started, discussions are going on. Therefore, the market is now deepening and widening and is welcoming of more and more participants, which obviously creates a bigger and bigger opportunity for both hedgers and financial investors. So I think Debo will now share with us his exchange perspective about commodity cycles and investor response. Debo, the floor is yours.
Thank you, sir. Thank you for this wonderful opportunity, firstly. And it was a delight to hear two of my gurus. I consider Chandrasekhar sir and Vikram.
God bless you. God bless you.
So much to learn from both of you. So I'll share a small presentation. But before that, a small disclaimer. So I'm talking. Although I'm representing MCX, whatever I'm speaking is something that I am sharing my personal perspective. My organization does not necessarily endorse or oppose any of these. So these are my personal views. And secondly, of course, there is no view that I would be giving, no direction, no price views, etc. If at all it is appearing that it is a view, please take it that this is not a view about the direction or the price movement, etc., or the the future outlook of the market. So the small introduction, I'll just share this presentation. Is my screen visible?
Yes.
Yeah. Go ahead.
Right. So basically, I'll try and rephrase a little bit what the two speakers, erudite speakers before me had spoken, and I'll try to give speak a little more on some of the aspects of this topic, which is about how investors should respond, and a little more compared to telling a lot about commodity cycles, which I think the previous two speakers have elaborated a lot. So one particular element of this aspect of commodity cycles I would want to mention is that we are at least in this presentation I am trying to talk about commodity cycles as a long-term in a long-term framework rather than something which is like a swing, a short-term framework. So when I say cycles, I am meaning a longer-term framework, possibly because the media today carries so much of news and analysis, etc., about super cycles and so on. Are we in a super cycle and so on? About that also I'll just touch upon. So this graph that you see is actually the Bloomberg Commodity Index, right from 97, 98 onwards till today. I think it was till last week. This is a composite index, commodity index consisting of 23 commodities from across different exchanges across the world. So as you can see, the graph, which is a broad indication of how commodity prices moved in the last more than 2 decades, it has shown an upward trend and then finally a downward trend, and then again, this year onwards we are looking at an upward trend. And what is the center of attraction today, the center of the discussion today, which is from the fact that from the last quarter of 2020, the prices seem to be on an upswing. But if you see in this, my main point of showing this graph is to tell you that if you see this upward curve in a broader perspective of 10-20 years, then the story seems to be whatever you want to interpret this as. For example, this upward swing was preceded by a kind of a secular downward trend from almost about 2000, I think just after towards the latter part of the last financial crisis of 2008-9. And afterwards, from 2010 onwards, this has been continuously falling. So it is in this context that one has to see the long-term commodity cycles, and whether there is a commodity cycle or is it, as I said, a upswing or a temporary upswing or a downswing, etc. So are we in a super cycle? Both yes and no. I would not hazard an answer. But then I'm just collating the reasons why people say we are in a super cycle, because the last year or so, thanks to COVID mainly, the policy focus has been on growth and jobs and not really financial stability. And what this means is that there has been a huge fiscal stimulus as well as monetary stimulus. I think both our speakers before me have talked a lot about it. US is still talking about a continuation of the stimulus. Of course, they're now started to talk about how to wind up the stimulus for the first time. However, the stimulus continues. And also the fact that years of low supply have led to producers to slow their investment plans. That is also something we have seen. And China's post-pandemic expansion, it is already started quite a bit earlier than many other countries have started. And what is being observed is that it's not just about metals, where China gets all the attention about, but it's also in agriculture. Yes. China's demand for agricultural commodities, particularly corn, is actually also pulling up agriculture commodity prices, something which was not witnessed earlier. So people like the economists at Goldman Sachs possibly are very emphatic that this is a super cycle that we are in. And then there are these naysayers who strongly disbelieve this. They are equally right. They have equally strong points, which say who say that these are just a cyclical post-COVID phenomenon, and therefore, if the stimulus is stopped, then probably this music is going to stop, and therefore this is a story of the stimulus and not really of any fundamental shift. And therefore, yeah, the point that I just now said, that there doesn't seem to be any compelling structural demand like the kind we saw in the previous cycles. So previous cycles that we saw, again, I'm making a distinction between a long-term cycle versus a short-term swing. You can hardly count on your fingers. The last time we had is from 1995, from the time, or 1997, I believe, when China entered the WTO, onwards up to the, the global financial crisis of 2009 and 10, started in 8 and probably continued till 10. China witnessed double-digit expansion and so on, huge expansion in infrastructure and so on. Many of it was a kind of a bad, investment. However, that actually pulled the Chinese economy. That kind of a thing doesn't seem to be happening now. This is what the naysayers are saying. So Today, China is a big factor, but China possibly is no longer as powerful a force as we saw in the first decade of the new millennium, of this millennium. So, the jury is out about whether this is a super cycle or not. So one has to take all of these factors into consideration before understanding whether this is a temporary or a more structural cycle. So I just wanted to show this what I just now told you in terms of prices, and I am taking MCX prices of 3 commodities, and I am comparing the prices of January to May, that's 1st January to 31st May of 2020, and comparing with the same period of 2021, 1st January to 31st May of 2021. So you see crude oil, we saw a secular downturn, and this year we saw a secular upturn. Cotton in agri commodities, same story, and so is the story in aluminium. So 3 commodities in 3 different segments all seem to be saying that there is a structural, there is a story that was there last year, and there is another story which is being played this year, and we do not know whether these are temporary or permanent. That is the bottom line of this. So if you were to link it with some macroeconomic factors, as always there are macroeconomic factors linked to the commodity cycles. Basically, there are 3 Ds. I think Chandrasekhar sir has already spoken some bit about this, but I'll just little bit elaborate on this. One is of course the dollars. So sorry. Yeah, the dollar, a weakened US dollar associated with zero interest rate and pent up demand, which is probably what has happened in recent times, can contribute to a super cycle, or call it an upswing, whichever way you want to say. And if you have an opposite situation, that means if you have strong dollar, sustained strength in the dollar, an interest rate which is strengthening or seeming to strengthen, and no circumstances of perceptible pent-up demand, you can have a prolonged slump. So this is what you need to see, how the commodity prices or the commodity cycles could be possibly behaving. Second is of course demography, which is not just about numbers, the population in an economy, but also the age composition. So if you have a country like India, which has the age composition is little bulged at the center, which means the people in the productive age group, which is 18 to 40 or 18 to 50, is constituting very high numbers and a high percentage in the aggregate population. You have what is called a demographic dividend, of course, provided you are able to take advantage of the demographic dividend. And then, of course, if you have kind of a pent-up demand or economic growth cycle going on the upside, then you could see a situation of increased commodity prices, which could sustain for a period of time. And of course, when you talk of demography, you also have to consider the growth in countries with higher commodity intensity in growth. India and China, of course, are examples, best examples that we have seen. So if the population is growing in those countries where the economic growth has higher commodity intensity, you could be having higher and sustained commodity prices. And of course, the developing country story, the third D, the story of the emerging economies. So which are the countries which are growing? Are these the countries which already have a high growth, are already on a high growth path? If so, then the demand that is going to come, and I'm going back to the first point that I've raised, which is about the pent-up demand, that is going to exert a greater and a more powerful pull on commodity prices, as against countries which are not in that category of the high growth emerging economies. So from now, my discussion is going to take 2 diverse strands. And the second strand is something I think the 2 previous speakers have spoken about a lot. I'm also going to talk about something which is about hedging. So the 2 strands are something like this, that when we talk of what investors should do, I look at investors as not just the people who are coming to the exchange or investing in commodities for making getting a higher return, etc., about which I'll touch a little bit, but also those participants in the commodity markets who are coming to this market to manage the risk that they are exposed to because of their exposure to commodities, and therefore this element of hedging. So the only certainty, it is said that the only known thing and the only certain thing in this world are, two things. One is death and another is tax. And there is only, I would add another third part to this, the only certain elements in this world, which is uncertainty and volatility in commodity prices. So like death and tax, you need to be
Good one.
cognizant of the fact that commodity prices are very volatile and uncertain. Now I'll just give you a perception about how volatile they are. When I present this table in front of you, as you can see, these are the annualized volatility in commodity prices over the last several years. Okay, so right from aluminum and copper and zinc to crude oil, to cotton, to silver and gold, take any commodity in any of these segments. As you can see, these are the volatility numbers, volatility represented by the standard deviation of the prices across the mean. So which means how much they are moving up and down, in an annualized form, these numbers are coming out. So for example, crude oil of 2021, it is 85% volatile. I mean, this is unimaginable for, it was unimaginable till some years back. But even something like, which is considered kind of insipid or boring, like aluminum or let's say cotton, it is around 16%, 15%, etc. Gold was about 18% last year. So what does it mean? It means that if you are exposed to these commodities because you are a producer of something which requires these commodities and inputs, or you are a producer of these commodities directly, this much percentage is something you are completely putting in a black box. You do not know what is the impact of this on your bottom lines. Okay, so you can do either of two things. You can take it in your stride. You can say, okay, I will manage, I will pass this on to my ultimate customers, or I will absorb this in my margins, or thirdly, I can do something to manage this risk. Now, I think with the sole exception of smuggling, I don't think there is any industry which has returns which greater than 17% or 18%, and therefore you are able to take it in your stride. You do not have margins exceeding these percentages that you can say that I can absorb it and yet I can be profitable, I can be in the green. You cannot. And in an increasingly competitive markets, of course, you simply also cannot pass on this to your ultimate customers. So what do? You actually do you have to manage this risk. And how do you manage this risk? You manage this through exchange traded derivatives, which are futures and options, because they are the best ways and the most effective ways and cheap ways to manage this risk. Now I put up that other table, which is annualized volatility for the currency pair, which is USD INR, just to give a comparison between the volatility in currency market, currency prices, and the commodity prices. So it's not to say that you should not manage currency volatility. Of course, it is very important. But all I'm wanting to say is that the amount of sensitivity a lot of people have about the currency volatility and the need to hedge that volatility, they do not seem to be having for commodity price volatility, although the commodity price volatility numbers, as you can see, are multiple times of the currency volatility. That is the whole purpose of, and the only purpose of putting in this table. So how and why the cycles and risks in commodities happen? As you can see, because of several factors, many of which having a long-term ramification, like shifts in global economic power and uncertain divergent economic growth, unpredictable moves, etc., rapid urbanization, demographic changes, a lot of things. In climate change is a very important factor, and all of these are causing this uncertainty, and in the short term, and cycle in the long run. Which is what one needs to be cognizant about, keep a track of, and manage the risk that is coming from these uncertain elements. You cannot do anything to these elements. These are beyond anybody's reach. But what you can do is prevent the impact of these factors on your bottom lines by managing the risk through exchange traded commodity derivatives. So I'm just sharing this. Some clippings of some real newspaper of some magazines. So this is a clipping from the Fortune magazine of 2015. I think it was April or May 2015. So as you can see, the commodity price slump. There was a big time slump at that time. The second one is from a blog of World Bank in April 2020. Again, there was this slump, and barely a year later, I think this was in the Business Standard newspaper, it says that there is a surge in commodity prices which is going to impact. So if slump in commodity prices or a surge in commodity prices both are having an impact on the economy or on corporate bottom lines, etc., obviously we need to know that we need to understand and we need to be sensitive to the fact that we need to manage the impact of this on our corporate, on our bottom lines, on our economy. Now I'm not going to say how to do that. That's going to probably take a lot of time. But then, yeah, we need to know that we need to do something to manage it. And now coming to the next trend of the impact of the uncertainty, which is about investing, which is about making money, which is about doing something to ride on this uncertainty, basically. So what you need to do is to the first thing, I think this point has already been made, that we need to distinguish between the fleeting booms and busts versus fundamental shifts in demand and supply. And previous two speakers have talked a lot about one particular or two particular. I think Vikram has talked about the impact of technology and the environment and how it is going to lead to a fundamental shift in demand and supply, which one needs to be cognizant of. So we need to identify the cycles and identify the fact that the super cycles, as they were, are relatively rare. So the only other example in the last 50 or 70 years before 1995, the example that I gave was the post-war situation of post-war, as in the post-First World War situation, post-1918, when again there was seemed to be a secular uptrend in commodity prices for several years. Between them, there wasn't much of a super cycle. And of course, this fact of the push to green infrastructure, the push to environment, social and corporate governance, the emphasis on these, electric vehicles, mining technology, change in mining technologies, all these are factors which are going to remain. I think the previous two speakers have also talked a lot about this. This example that I wanted to tell you about is the Green New Deal of European Union. EU wants that by 2050, they want to be completely carbon neutral. That means as much of carbon they would produce, they would also absorb. So there would be no new addition to the carbon contribution from EU at least. And for that, they have a very ambitious 1 trillion euros investment plan drawn up from now till 2050. I mean, now till I think 2040. By 2050, they would want to see the results coming up. So that's very ambitious. We do not know. A lot of people are skeptical about whether $1 trillion, 1 trillion euros EU would be able to garner. But however, the point is that there seems to be a lot of movement in this direction. Even if it is not 1 trillion, even if it is half of that or a quarter of that, definitely that would have some impact. And the impact of which would be felt on commodity prices. The other point you need to remember is that commodities are not a homogeneous group. We always talk about commodities as if they are homogeneous group, they're going up and down together. You need to know that price dynamics are idiosyncratic. What moves cotton prices is not the same as the factors that move aluminium prices, which are not the same thing as move crude oil prices or gold prices. So you need to understand that. And although there are certain common factors, which are probably the two of the factors that Chandrasekhar Sir had spoken about, the last factor, his sixth factor, the fund factor, and of course the monetary policy factor. But beyond that, the fundamentals are all different, and therefore one needs to be cognizant about that. So there would be different cycles within the aggregate cycle, and one needs to know and understand that. And of course, the transition away from fossil fuels to renewables, this is something you need to know and you need to consider. I just remembered, I think the International Energy Agency, IEA, it has it has said that recently that this transition to renewables, etc., it is going to lead to almost 25 times increase in demand for something like lithium, sorry, 40 times for lithium and 25 times for even the traditional metals like aluminum and cobalt and so on. Now, this is also, repeating Vikram, who just now spoke. It is not percent. We are no longer talking about percentage. We are talking about X, 25X and 40X is what we are talking about. Use of biofuels. Chandrasekhar sir has spoken a lot about it. How crude oil prices or crude oil prices could directly lead to a increase in demand for biofuels, or whatever. They have a direct correlation. And the example from China that I told you, the increase in demand for corn in China last year onwards and continuing this year is actually a demand for biofuels more than anything else. So how do you, what do you all keep in mind when you invest in commodity cycles? You need to study the specific commodity cycles, as I just now said. You need to understand the USPs of commodity investment, which are different from the investment in other asset classes. You have this advantage of portfolio diversification. Commodities offer the best benefit of portfolio diversification, and therefore you need to think of your portfolio as a multi-asset portfolio, which needs to include, among other things, commodities also. And of course, the fact that commodities are a natural inflation hedge. So if you are facing inflationary trends, prices of things are going up, then commodities being those things actually gives you an natural hedge in your portfolio. A lot of studies are there which find a superior value of portfolios with commodities. I'm going to shortly share you the link of a study done by IIM Kozhikode, which is on the website of MCX. I'm going to shortly put in the link. So it also finds that there are several others which have found that there is a superior value of portfolios. Value as in the risk-weighted returns, risk-adjusted returns of a portfolio with commodities is higher compared to if you are taking any individual asset class. So, how should investors respond? You need to, as I said, identify the cycles. You need to learn and invest and start with, this is again a personal recommendation. You can start with paper trading. You learn, you educate yourself, and then you know how to invest with actual money. Do not over leverage. It is easy to over leverage because we are talking of commodity derivatives. Derivatives by definition are a leveraged market. And always have apply stop loss and consider basket products which are having less volatility compared to individual commodities such as index futures. We already have index futures in the market. So coming to the tenets of safe trading, some do's and don'ts, as you can see, these are all available on the exchange website. I will not go through in details. I just want to share this last slide, which is telling who is the responsible investor, and probably that will answer the question, what should investors do in case of commodity cycles? You need to track the physical market. You need to track the economy, the fundamental factors, both the global economy and the local economy, the domestic economy. You need to know your financial limits and your risk profile and only invest accordingly. You don't bet on the market, but you take informed decisions. You are not misguided, misled by brokers. Why just brokers? You simply get, on WhatsApp and on social media, you get a lot of tips which are absolutely unwarranted. Do not get misled or misguided. And we don't overtrade or try to recoup losses. In case you're making losses, you don't do more trade in order to so-called trying to recoup these losses. It might lead to more losses. And finally, you need to track your position continuously. This, if you do this, then you are a responsible investor, and you can definitely ride on the investment cycle or the commodity cycle as an investor. And of course, as a hedger, I just told you in some of the previous slides what all you need to do in order to firstly be cognizant of the risk, and then use commodity derivatives to manage that risk. So that is all I had to say. Thank you.
Oh, thank you, Debo. Very well spoken. Excellent, particularly your advice to investors and your tips, your guidance for how to be a responsible investor. I think point extremely well taken. Very nice. Thank you very much.
Thank you.
We are actually, we're slightly overshot the time, but I'm sure I don't want to finish it in a hurry, maybe another 10 minutes. I just want to, because Vikram talked about China and Debo also talked about China, I just want to make one mention. Between 1995 and almost 2010, was it no 2015? Yeah, I think now I remember 2015. China's growth was very substantially driven by fixed asset investment. It was called investment-led growth. Okay? And therefore, construction of buildings and flyovers, infrastructure projects, etc. In 2015, the Chinese policymakers took a very conscious decision. That conscious decision was to move slowly away from fixed asset investment to a consumption-led growth. Instead of investment-led growth, China is moving to consumption-led growth. But it's not just a complete U-turn, but it's a very gradual shift. And therefore, we are able to see that gradual shift from 2015 to 2020. Last year, the Chinese, whatever they call it, Politburo, or the top policymakers had a meeting. They reaffirmed that it is going to be consumption-led growth. Therefore, when you have consumption-led growth, the composition of your import, the composition of your economic activity is beginning to undergo changes. And therefore, that's one of the reasons why China is not able to keep up the kind of growth rate that it saw in the early part of this century, the last decade. They're not able to keep up, but yet their prosperity levels are increasing. So we are looking at it only from a commodity perspective, but overall, as a nation, their GDP is going up and $13 trillion, etc. I think that's a great story to track, and I have extensively commented on this. And that is why I said there is no other country on the horizon which is similarly situated as China of 15 years ago or 20 years ago. But anyway, we have the potential, but I'm not sure. India has the potential, but I'm not sure whether we are not in that league. We are not in that scale of China. Anyway, but Debo, thank you very much. I think I thoroughly enjoyed what you spoke. It's very, very interesting. Before we go into the questions, Vikram, any other comment that you have to make? Do you have any thought that is occurring to you now? You have any closing remarks, so to say?
I think, thank you very much for permitting me that. I think one thing which the investors should, appreciate that today, the equity markets are at all-time high. And, obviously at some, fortunately for the, as they say, the only free lunch in the financial market is diversification. So today, when you are, obviously equity and debt have got track record of many, many years, you don't need mind endorsement. And so as commodities like gold, etc., which have got track thousands of years, they don't need my endorsement. But I think what we should also look at is that as an investor, you should not be in a position where your portfolio gives you fabulous returns for 9 years, and 10th year when you need the money, it is well under the water. And this can happen, you never know when the next disaster strikes with the global economy. And how can you prevent that? You diversify your portfolio. Have equity, debt, have commodities, have gold and everything. So that at least worst case scenario, even if there's a hyperinflation or whatever, third wave, fourth wave, at least some part of your portfolio will be in green. And Murphy law is very, very much harsh on investors. That
Absolutely.
Whenever you need money, your portfolio will be down under the water. So diversification into commodities is something we should look at.
What can go wrong will go wrong. That's another Murphy's law. But very well said, Vikram. I'm tempted to take 2 minutes to talk about something. If you all remember, gold prices increased double-digit year on year from the year 2000 till the year 2012. Okay, 12, 13 years, double-digit growth was an extraordinary. bull run for gold, and that led people to believe that gold prices will never fall. And believe me, those years in business line, we used to have a Sunday edition. Now, of course, we don't. We've just restarted. We stopped Sunday edition. We restarted recently, but I used to run a particular investment column on Sundays. And beginning January 2013, for several weeks, I talked about the fact that gold was ready for an imminent correction from the level of $1,680 an ounce, $1,700 an ounce. That was the price early January. And people would even write letter to the editor. Who is Chandrasekhar? What does he know about gold market? He's predicting that gold prices will fall. All that. Let me then come to specifically 13th or 14th March 2013. At the BSC, there was a conference on gold investment, and I spoke. I said, today this is the price. I think it was 31,000 or 32,000 rupees Indian price, 10 gram. And I said, I am looking at an imminent correction and a big correction in gold prices in about 4 to 6 weeks, or in about 2 or 3 months, or whatever. That's the timeline I said. People laughed at me saying, yeah, what do you know about gold market? Now go back to 15th April 2013. There was a meltdown in gold price. From 1660, it came below $1,300. It's all a part of record. It's all in the archive, $1,300. I'm saying if an ordinary journalist like me can, I'm able to foresee what is going to happen in the market. And based on, of course, research and looking at the drivers and all those drivers that I talked about, I'm sure savvy investors must be lot more savvier and more intelligent and more rational than an ordinary journalist like me. But then a lot of people lost. From 32,000 rupees for 10 grams, gold collapsed to below 27,000. That was the time. And I could see it was coming. Anyway, then, of course, all that happened. The point is, as the Vikram rightly said, you have to be, and Debo pointed out, you have to be glued to the market. It can't be a part-time activity. It is unlike the equity market. You take some shares of top company, keep it for 3 years, you know, prices will rise and then you sell. The commodities, you need to be glued to the market almost 24/7 in order to benefit. But then there are some long-term trends, as Vikram pointed out, where you must have the patience. You must have the patience to wait for the results to appear. Thank you very much. Thanks. And Debo, you have any comments, additional comments to make before we go into the questions?
No, first, thank you. And yeah, I just wanted to comment on your first comment about China. I think it's very interesting, you know, from China, you get to hear about certain words that are completely foreign to the Indian audience. Things like over-investment in infrastructure. You know, which Indian thinks of over-investment in infrastructure? They created ghost towns where nobody was ready to move in, ghost railway tracks.
Exactly.
So I mean, that's not going to happen. China made a mistake.
Exactly.
They followed a strategy which is not sustainable. And
they realized,
therefore, we are not going to see those days again.
Exactly. So they realized, therefore they are moving to consumption-led growth from investment-led. But that does not mean investment will not take place. There will be further investment in fixed asset, but at a much muted or smaller scale. Anyway, can we go back to the questions and take very quickly 5 minutes because we have already overshot our time. There are business cycles in all products and also for companies, but the apathy of the government remains constant at the nadir always. Okay, that's a comment somebody has made. Dollar index and currency fluctuation and its impact on gold. No, we are not any view, not price view, but how does dollar index and currency fluctuation impact gold is a question, Vikram. You want to say something?
Yeah, absolutely. I mean, gold is a currency, and it's like rupee. You know, when dollar strengthens, rupee weakens. Similarly, gold is a currency. When dollar strengthens, the gold will weaken against it. Both two are are each other's replacement.
Inversely correlated.
Exactly, and both
Right.
that will happen.
Absolutely. Correct. I agree. Okay, then there is another. What can be expected from OPEC Plus meeting? There's a meeting on 1st of July. I love this question. But I think the OPEC is under a lot of pressure to step up production. And maybe they may not decide, my view, they may not decide in the 1st July meeting. But going forward in the next meeting, whenever it's going to be held, maybe August, maybe September, I think they will now decide to step up production. They've already decided 3 months ago to raise it by 800,000 barrels a day. They will possibly make it maybe 1 million barrels, or it could be more. If the world is lucky, they will decide on 1st July to step up production. Otherwise, probably at some stage in future, maybe 2 or 3 months later, they are under so much pressure to raise production. It's certainly going to happen. This is my view. And the market is actually expecting that the OPEC will not decide to step up production, and that is why today crude prices are something like $76.50. Brent is around that level. Is my feeling. Okay, why has the rupee weakened against the dollar despite having over 600 billions in forex reserve? Okay, shall I? I'll just share as a layman. I want to mention the rupee and the dollar are in some way again inversely correlated. When the dollar loses strength, when the dollar weakens, the rupee, all the emerging economic currencies actually gain strength. And when the dollar starts to gain strength, particularly vis-a-vis the euro, because that's the reference currency for the dollar, when dollar begins to gain strength, the emerging currencies start to weaken. I think our $600 billion in forex reserve it's a big strength, but that also has to be appropriately deployed in order to shore up the currency. I'm not sure if we are doing a good job of that. Any thoughts on that, Vikram? Why is the rupee weakened against the dollar?
Personally, I think rupee is one of the most overvalued currencies in the emerging markets. If you look at Russia and other countries, now it has also helped in keeping inflation down. But then at this point of time, we have bigger problems than to cater to the export market. But at some point, I think when it starts, affecting the exports. So today, exports are not getting affected because there's a boom in the global economy. But so far, we have not faced that competitive issue. But I think at some point it has to be addressed. Whether it is end of this year or next year, I don't know. But we'll see some sort of recalibration of INR USD. It has got nothing to do with the reserves.
Yes. Fine.
Also, I would like to point over here is the role of expectations. So this person has written about 600 billion. Now whether that is enough, whether that is as they call the ammunition in the for the Reserve Bank of India to for a meltdown, for a sudden attack on the rupee, that your perception may be different from mine. So that the role of expectations is very important in this.
Bilkul. And second, look at the persistent trade deficit. 100, 120, 150 $1 billion trade deficit. Our imports are much more than our exports. But there is a trade deficit, which obviously contributes to weakening of the rupee. What impact the US central bank, Fed reset or taper tantrum regarding the interest rate will be on the commodity market? No, I think we should understand there are two aspects. One is the interest rate. Second is the tapering. Okay, tapering is reducing the liquidity available in the market. And then therefore the Fed has very clearly said lower for longer, which means the low interest rate will continue for quite some time. But in the meanwhile, they'll start sucking out liquidity or sucking in liquidity. And therefore, when liquidity starts to drop, the amount of dollars available for financial investors to invest in asset markets will start reducing. And when the interest rates start to rise, that will have even more negative impact on various asset prices. But But contrast that, when will that happen? When will the US start raising interest rate? One is, of course, inflation. Second, when the US economy starts to move, starts to grow robustly, that will send a positive signal about the economic outlook. And therefore, it's an interplay of economic growth and currency. Anything, Vikram? Do you have a view on that?
So Federal Reserve has got an enviable task of, every crisis is an experiment in central banking. This
Yes,
is what
right, absolutely.
and they'll have to, it's like a mosaic jigsaw puzzle which they have put together, but they need to also, remove the pieces also. And if you remove the pieces too soon, it might collapse also. So it's not an easy job in their hand.
I know it is not.
And I think if the markets will correct, all types of market will correct, if they lose faith in Fed's ability to unwind, or if they feel that the Fed is not in too much control, then it will have a very drastic effect in all markets, not just commodities. So that is why I think they have been saying repeatedly that we will err on the side of caution, so that they are not to be seen as being rash on that. But yeah, it's going to be interesting and very volatile times ahead. But again, as a canny investor, keep some powder dry. You find good opportunities to buy everything.
Which foreign company is investing directly in manufacturing in India? I don't know. I don't have a ready answer now. I don't know if other panelists have anything to say, but I don't have a ready answer. Can precious metals like silver and gold do well if there is increased demand? Say silver for solar energy, electric vehicles, even though the dollar index goes up.
So you see, gold, I'll tell you what is happening with gold. The fundamentals of gold have not changed. I mean, it was in a bull market even before COVID happened. But what happened in COVID is it added billions and billions of dollars of investment, open interest to it, which is coming out of it. And that is why gold prices are underperforming. How long? With my guess is that roughly half of that is already out. Will the remaining half come out? I don't know. But I think the safe way to play the market is to give it some more time, see where, allow the dust to settle, and then perhaps take a view on gold. It is quite frankly speaking, it's got nothing to do with the gold fundamentals or long-term story. It is just a buy and sell of investors, which is the unfortunate part is that today we live in times of Microsoft and Apple, where the market capitalization is $1 trillion, $2 trillion. So hundreds of billions of dollars get thrown around, and as long as it is thrown in, it is good. But when it gets thrown out, it creates a problem. So that is why gold is facing this problem.
Correct. That's right.
And same with silver.
I agree. How to hedge overnight fluctuation like crude oil? Can we be able to trade 24/7 in India? INX to overcome volatility, or is there any facility available in India? Any thoughts, Debo? You have something to say on that?
Yeah. So we can 24/7 is in on an exchange like MCX. You can trade till midnight.
That's right. So correct.
From 9 o'clock
24/7 will happen gradually. Yeah. It is bound to happen at some stage, but it'll take some more time.
Yeah. So also, that's as good as 24.
Yeah. Also, I think I'll tell you with my experience, we are holding quite a decent amount of crude in one of our funds, multi-asset fund. In the global market, after the US closes and before the Asian market opens, unless there is something drastic happening, which happens maybe once in 5 years or 10 years, like a 9/11 or a COVID or whatever it is, unless that kind of thing happens, you will not find too many overnight movement. The gap up and gap downs will be commensurate with the long-term volatility of crude oil. So it is not needed actually, and it should not be inclined to follow the market tick by tick, because it will, as they say, the screen will always conspire against your position. You're short, it will go up, and you're long. So it's just that take a position with conviction, with fundamentals, this thing, and then don't worry about when the market is opening and closing.
Thanks. Then there is a question. It's so many factors affecting, mainly global factors. How to start analyzing any study material, papers, books. Well, that's you'll have to go through some training program. I'm sure MCX used to do
Yeah.
some training program,
We have.
right? Is it still continuing?
Yes, we have.
Yeah, I think.
Yeah.
Yeah.
So on the
I think you
exchange
should look at
website,
the MCX
yeah,
MCX website. I'm sure they have.
there's
some
a
training program.
section called education on the MCX website. Please visit there. There are a large number of training programs being conducted. There are certification programs. Please go through. Else, please drop in a mail at research@mcxindia.com and it will come to me and I can guide you.
Right.
Otherwise, on the education tab, there are lots of materials.
Also,
Awesome.
alternatively, you can alternatively. I'm sorry to sell shop over here, talk shop over here. Alternatively, you can, trust the fund managers, the mutual funds who are also managing products with commodities, direct and
Yeah.
indirect. Manage some part of your money. We'll try our best. We don't guarantee anything, but we'll try our best.
Very true. Point. Very well taken. Can silver do well due to industrial use, even though the dollar index goes up? Can the inverse correlation be broken?
Silver, I think, is on the mend, and the surplus is going down in silver.
Yes.
Because in a very long winter actually. If you were a silver trader, you probably would have need half a generation to wait out the next rally. But I think what you need to remember over here is that with regards to silver, the biggest driver of silver demand is solar. If you are bullish on solar, roughly today about 10 to 11% of the consumption of silver is in solar, and this is without the India story, opening up and so many other places. If you're bullish on solar, then silver can be a good proxy. Obviously, it's very volatile, but thankfully we live in times of Bitcoin, so anything silver, it looks like actually a garden picnic in front of Bitcoin. So, but I think in volatile commodities like silver, you'll have to have patience to buy. We hold silver in one of our funds, in multi-asset funds. So yes, so it can be a proxy for the solar. No, your call is muted. So you're muted. Chandrasekhar sir, you're muted.
Yeah, perfect. So I was saying that I think we have already overshot our time. It's unfair for me to hold back two of our very respected speakers and of course a whole lot of participants. There will be questions. Write your questions either to IMC Anita Naik or write your questions to Debo at MCX. I'm sure he has posted his email ID. Anita Naik, you post your email ID in the chat box. I want to thank Vikram Dhawan, my friend, wholeheartedly for participating in this and taken time off. Vikram, I'm not going to let you go with just this one event. I'm sure we are going to be doing a lot more with MCX, and we'll certainly invite you. And of course, Debo is somebody I've been working with for quite some time, and I'm so delighted I was delighted to hear Debo's presentation today. Very nice. Thank you very much, Debo. A great job. And with this, let me also thank all the participants for staying with us for almost 2 hours. If there are questions, as I said again, there will be questions. Please feel free to write to IMC and to MCX. We will try and respond. With this, we will conclude this very interesting conversation this afternoon. Good luck. God bless you all. Stay safe. And we will let you know when our next event is. IMC will be sending a circular to everyone. Thank you very much. God bless.
Thank you very much.
Thank you, sir.
Thank you, everyone.